Hello, I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, Donald Trump signals a dramatic U-turn on U.S. energy policy. The president says he's unleashing oil. Is the American energy landscape being reshaped, and how will the rest of the world be affected? Big banks have pulled out of climate change groups. So what's behind the exodus? And are financial institutions still in the climate fight? And Trump has pledged to make the US the crypto capital of the world. He's launched his own meme coins. But is that a conflict of interest? And will his policies boost his own digital asset, as well as cryptocurrencies in general? A dramatic pivot to fossil fuels. President Donald Trump says that he will increase oil output and unleash the already booming U.S. energy production industry. He's also declared a national energy emergency, the first president to do so. While oil companies might be celebrating, Trump also pledged to roll back support for clean energy, spelling trouble for that sector. Now, he says his plans are aimed at achieving domestic prosperity and curbing inflation, since oil and gas prices touch every part of the economy. But the measures could have serious implications across the entire energy landscape, from oil fields to wind farms, and the ripple effect could be felt worldwide. We'll discuss all of that with our guest in just a moment. But first, a report from Dmitry Medvedenko.
On his first day in office, Donald Trump made quite the entrance, issuing a flurry of orders, which include declaring
a national energy emergency. We will drill, baby, drill.
This will help issue permits to oil and gas producers much quicker, ignoring ecological concerns.
America will be a manufacturing nation once again, and we have something that no other manufacturing nation will ever have: the largest amount of oil and gas of any country on earth. And we are going to use it. We will bring prices down, fill our strategic reserves up again, right to the top, and export American energy all over the world.
Trump's decrees include a resumption of liquefied natural gas exports, withdrawal from the Paris climate deal, something he also did in his first term, an order to allow the U.S. to drill for oil in the Arctic, notably in Alaska, and topping up U.S. strategic oil reserves, which the Biden administration drove to a 40-year low, trying to curb gasoline prices. The U.S. is already the largest oil producer in the world, and has been for the past 6 years.
At present, the U.S. face no energy shortage and fossil fuel, but because of the role of the very important role of the energy security in U.S. national security and economic security, during the Trump second term, we can see more invest from the domestic side in production of the oil and gas, especially in the shale side and especially in the Alaska region.
Oil is traded on international markets, where prices move according to supply, demand, and geopolitics. If the U.S. pumps more oil, the price per barrel could fall, meaning cheaper gas for consumers. But OPEC nations can offset that by limiting their own production, keeping global prices stable. Whether they will remains to be seen. Trump's energy plans have angered environmental activists, who will likely challenge his policies via the courts in the years to come, just as they did in his first term. Dmitry Medvedenko, Al Jazeera, for Counting the Cost.
Ed Hers is an energy economist and lecturer at the University of Houston. He joins us now from Houston. So Trump has declared an energy emergency. What do you make of that, Ed? Is it more to do with politics and money, or is there genuinely an energy emergency in the U.S.?
There's no emergency. I think it really has to do with politics and the fact that President Trump promised the voters that he would lower the price of gasoline to $1.87 a gallon, and that he would lower the cost of electricity, which has been going up across the United States. He's also promised the U.S. oil patch that we would drill, baby, drill to accomplish this. But as we all know, it takes higher prices to encourage Wall Street to invest, to drill more wells. And to get to $1.87 a gallon gasoline, that would mean the price of oil would have to be less than $50 a barrel. And in the Permian Basin, across the West Texas oil patch, which produces about 4 million barrels a day, rigs are being laid down at prices of $70 a barrel. And in a recent Dallas Federal Reserve Bank analysis and survey, more than half of the producers indicated that they would not be drilling new wells unless the price remained above $70 a barrel. So, in the first instance, President Trump's initiatives would appear to be mutually exclusive. Going ahead, we know that the tariffs that he proposes to put in place will increase the cost of drilling dramatically. The tubulars, I know of many in the oil patch who are currently acquiring tubulars and even hoarding them for the casing, the piping downhole. 25% increase in the cost of steel coming across one border or another is going to have a serious impact and again diminish the opportunity to drill more in the United States.
You talked, Ed, about US oil producers needing the price of oil to stay above $70 a barrel. What will this drill policy mean for OPEC and producers in the rest of the world?
Oh, it won't mean anything for OPEC. The U.S. oil patch has been battered by various policies, volatile policies from one administration to the next over the last 30 years. And Wall Street is exacting a discipline on the oil patch across the United States. The president just asking people to drill is not going to make it happen. Opening up lands in the Gulf of Mexico, the Atlantic seaboard, I mean, these are areas that President Trump in his first term put off limits to oil and gas development. Alaska, the oil patch abandoned Alaska more than 10 years ago, and we all recall Shell Oil losing a rig there. It's not going to happen. Everyone in the United States understands that the U.S. is the high-cost producer in a global commodity market. We've been in a price war with OPEC that just didn't turn out well. And we remember that in 2014, 2015, 2016. And in fact, during President Trump's first term, he was able to convince Saudi Arabia to keep the flow of oil up and the price down. That bankrupted a large number of U.S. oil producers at that time.
The president has halted more than $300 billion in green infrastructure funding. What does that mean for the green energy sector, the climate itself, and the transition to cleaner sources of energy?
Well, the cat is out of the bag. The energy transition is underway. We've just been through a horrible winter storm in Texas, and it was wind energy that kept the grid going and alive and operating perfectly during this really difficult ice and snowstorm. It's still below freezing right now. President Trump can't put that back in the bag or reverse it. He can slow it. Keep in mind that the major oil companies understand that we need to reduce our carbon emissions. And in fact, polling for the last 15 years across the United States comes out with a 76% desire by the voters to have a cleaner environment with less emissions. That's where we are going. Simply reversing the funding that the IRA is producing also is going to be problematic for the Trump administration. More than 80% of these funds are being expended in Republican states and Republican districts. That's where the energy infrastructure is. Houston is the energy capital of the world. The technology, the intellectual property for oil and gas and for batteries and for wind and solar reside here with our major universities. It's going to be difficult to turn this off.
So the money that has been invested so far in the transition to clean energy hasn't gone to waste?
No, it hasn't. This money has been useful in advancing the cost curves. Certainly, China is the global leader in the production of solar panels, but a lot of that technology came from NASA here in Houston and from the United States. It's a question of allocating the production, the implementation. One of the challenges that President Trump would have in lowering the cost of electricity for Americans is that it's never been cheaper. It's driven primarily by the price of natural gas across the United States. Currently, that price has averaged less than $4 per MMBTU for the last several years. That's driven U.S. electricity prices down. The tremendous inroads that solar farms and wind farms have made across the United States, especially in Texas, further will push the price of electricity down. But keep in mind that more than 10 years ago, before the energy transition was in full swing, the assessments were the United States was going to have to spend at least $2 trillion to upgrade the infrastructure of our electricity distribution system. Everything in the United States in infrastructure terms has been neglected for several decades. You know, no politician, no elected politician wants to spend money that has to be paid for with increased taxes. And that would come from roads or buildings or sewers or water infrastructure. And our electricity infrastructure has suffered in the same way.
Ed, it's been really good to talk to you on Counting the Cost. Many thanks indeed for being with us.
My pleasure. Thank you.
Donald Trump held off on his threat of tariffs on his first day as president, but he said he is considering imposing a 10% tariff on imports of Chinese-made goods as soon as the start of February. Now, that could impact Chinese businesses, which have invested heavily in African countries. Nicholas Huck reports now from Senegal.
This Chinese-owned factory in Senegal manufactures trousers, shirts, and shorts sold in U.S. stores, feeding what manager Mohamed Sarr describes as Americans' appetite for fast fashion. But with Donald Trump's return to the White House, he's worried African countries will be caught in the middle of a trade war between the U.S. and China.
I work for the Chinese, but I chase after the Americans. They're the customers, and the customer is always key. We have to keep the Americans satisfied because our link to the Chinese is only the raw material, the fabric. If our leaders reopened local fabric factories, we could easily move on from the Chinese. But we can't afford to lose the customers.
Under the African Growth and Opportunity Act, countries on the continent can export goods to the United States duty-free. It takes just 14 days for the clothes made in West Africa to reach American shores, compared with the 9 months it takes for shipments from China. Senegalese workers here produced over 1 million garments, all destined to the United States. They were sent just 2 weeks ago. There is enormous potential here, but look at the factory floor now. The owners are waiting to hear from Trump's new administration's decision on existing trade deals. And so this Chinese factory in Africa holds by a thread. Trump says current trade agreements are unfair to American businesses, putting their future in doubt. In February, he's due to visit the continent for the first time when he attends the G20 summit in South Africa.
With this G20 presidency, I suppose Trump will be looking more at quick wins for American businesses, for American financial institutions. He wouldn't really be looking towards building partnerships that will be bringing about stability, which is the biggest thing that is racking a lot of African countries.
Trump's return to power comes as West African nations sever ties with the U.S. for Russia, and U.S. support for Israel strains African relations further. Amid this uncertainty, Sarr searches for new buyers, shifting trade potential away from the United States and into the hands of its rivals. Nicholas Hawk, Al Jazeera, Diamniadio, Senegal.
It aims to accelerate climate action among financial institutions. The UN-backed Net Zero Banking Alliance is a voluntary network of global banks committed to align lending and investment portfolios with net zero emissions by 2050. But critics, including the US Republican politicians, say that the industry group was effectively coordinating a boycott of investment in the oil and gas industry. Big banks and asset managers are now quitting the climate change network, NZBA. Well, last week, 4 of Canada's biggest lenders said that they were withdrawing from it too. That's after 6 of the US's largest banks quit the group, including JP Morgan, Goldman Sachs and Morgan Stanley. European banks have threatened to pull out of the group as well, unless it softens its rules. The US Federal Reserve has said that it will quit another group, the Network for Greening the Financial System, because, it says, its work has broadened beyond the central bank's mandate from Congress. Todd Court is a senior lecturer in sustainability at Yale University. He works at the intersection of sustainability and investor value, and he joins us now from New Haven, Connecticut. Good to have you with us, Todd. Does this mean that lenders are going soft on aligning their portfolios with climate change goals?
It's actually unclear what the banks are going to do behind the scenes of these announcements. It could be that they are going soft, that they'll use this as an excuse to allow more climate risk and climate emissions into their portfolios, or they might just leave the Net Zero Banking Alliance as a method to allow them to diversify their portfolio, keep fossil fuel companies in, and let these kind of climate risks climb within their portfolios.
All right. So do banks still recognize the risk that climate change poses to their lending portfolios?
Yeah, I think it's clear that at this point that lenders, banks, any financial institution understands the risks of climate adaptation to their portfolios, whether that's severe weather or droughts, disruptions to business, et cetera. The challenge is that in the short term and in the proximal effect, having fossil fuel companies having high emissions in your portfolio will have strong returns. But in the long term, those climate impacts are going to be negative, but they'll be distributed, and that's future cash flow, which means it's discounted. So we're weighing, as a bank or a lender, those short-term immediate benefits against potentially catastrophic long-term negative impacts. So
what's this really all about then? How do we explain why banks and lenders are leaving the NZBA and other climate-focused groups? Is this purely political?
Actually, I don't think it's very political at all. I think this is just down to a financial or fiduciary decision. There's pressure from shareholders to show short-term returns, and excluding high-emission companies from your lending portfolio can reduce your returns in the short term. The politics, I think, are that boat has sailed. Banks understand those risks, and they're going to integrate climate risks as effectively as they can. But these announcements, the lack of commitment to the Net Zero Banking Alliance, for example, really reflects, I think, a financial decision by banks to focus on short-term returns to appease shareholders. And that you can avoid the politics by just avoiding the terminology that are the hot button terms that politicians care about.
What? So you're saying that the banks will continue to walk the walk but not talk the talk? I mean, isn't that incredibly short-sighted of them?
I hope they continue to walk the walk. It's possible that this is just a harbinger of giving up on climate emissions entirely and allowing that risk into the portfolio. But my sense is that the vast majority of climate risk is understood by banks, and that they'll keep an eye on that in the portfolio. And so what we'll see is while they won't constrain themselves to a particular commitment, they will continue to report on those climate risks, mitigate those climate risks in their portfolio, and disclose that to their shareholders as a matter of course, but just not within the constraints of a particular commitment like the NZBA.
But what message, Todd, is this sending to smaller banks and lenders and to the wider economy?
Yeah, I don't think it's a good message. So if large banks, make a public announcement that they're no longer going to be constrained by these commitments, even if they continue to integrate those risks into their portfolio, it sends a public message that they care less. So perhaps smaller banks decide they're not going to wade into these climate risk waters because it's too complicated. Or maybe the recipients of the loans decide, well, we don't have as much pressure on us to reduce emissions and to keep an eye on this. So I think broadly, getting out of these commitments sends a poor message around climate risk to the economy. And we might see a slowing down as a result of commitments among the companies that are taking these loans on.
Todd, it's been really good to talk to you on Counting the Cost. Thanks for being with us.
My pleasure. Thank you.
Now, in sharp contrast to his predecessor, President Trump has promised to usher in a golden age for cryptocurrency. On the campaign trail, Trump pledged to create a strategic Bitcoin stockpile and appoint financial regulators that take a more positive stance towards digital assets. Bitcoin and other digital coins have skyrocketed since he won the election in November, but the president's family is invested in the cryptocurrency market, raising questions around a conflict of interest, and even more so after Trump launched a so-called meme coin of his own. 3 days ahead of his inauguration, on January 20th, Trump launched his own Trump token, followed by his wife's Melania coin. But both shot up in value, drawing in billions of dollars in trading volume. Trump's coin became a top 20 cryptocurrency. The Trump-affiliated companies behind these assets say they're not an investment or securities, but a means of showing support for the power couple. So what are meme coins? Well, they started off as an internet joke, hence the name meme. There are thousands in existence and anyone can create one. Meme coins are often highly volatile and can shoot up or nosedive within a day. The first one was, of course, the Dogecoin, which started off as a satire on cryptocurrencies, but became a top 10 cryptocurrency market worth up to $85 billion. Its value has increased almost fivefold in the past year. Trump's token isn't the first digital asset he's tried to sell. In the past 2 years, he's released a series of NFTs, or non-fungible tokens. The digital images show him in various cartoonish ways, from cowboy to superhero. Lee Reiners is an author and lecturing fellow at Duke University and a former Federal Reserve economist. He joins us now from Durham, North Carolina. Good to have you with us, Lee. Is there a conflict of interest here? Has Trump acted unethically by launching his own coin?
Well, I think there's a pretty clear conflict of interest because the regulatory environment in the U.S. around cryptocurrency is very much uncertain. And on the campaign trail, Trump publicly said that he wanted to make the U.S. the crypto capital of the world and roll out this, sort of light touch regulatory framework for crypto. So now, 3 days before he's sworn in, he's launched his own cryptocurrency, and he's going to have the ability to influence how his cryptocurrency is regulated and how the entire industry is regulated. So that's the first conflict of interest. I think what's even more concerning from my standpoint is that now any entity, individual has the ability to directly curry favor with President Trump by simply just buying his cryptocurrency and pushing the price up. So it makes influence peddling a lot easier. So there's, conflicts of interest along multiple lines here.
Okay, and is there a regulatory framework in place to sort this out, to bring it to light?
Well, I mean, look, I think there's the question, there's one question, which is there a regulatory framework? I would suggest, yes, there is. But then the next question is, well, will that be enforced? Will it be applied to this specific instance here? And I think the answer to that question is probably not. President Trump already has a majority at the Securities and Exchange Commission in terms of Republicans. He's nominated someone else who to be the chair of the SEC, Paul Atkins, and Mr. Atkins seems to be favorably disposed to crypto. So I don't really foresee any type of regulatory action ever coming against the Trump organization for this cryptocurrency they've launched here.
And with his launching his own cryptocurrency, will that bring crypto more generally, do you think, into the mainstream? What is his motivation, do you think, here? It's all about making money, of course.
Yeah, I mean, it's hard to spin it any other way, frankly, and certainly he has made a lot of money in the first couple of days. It's interesting the reaction that you've seen, from the crypto community, which has been overwhelmingly negative because they've been trying very hard over the past couple of years after, FTX and Sam Bankman-Fried imploded to sort of recast themselves as, a responsible industry that's, just driving innovation and wants, clear rules of the road so that they can operate. And then along comes, President Trump and launches this just clearly speculative cryptocurrency that serves no purpose whatsoever. And the industry recognizes that this is not a good look for them, that this could actually undermine a lot of their efforts they've taken, over the past couple of years, to come across as legitimate. So I actually think it's counterproductive for the crypto sector in general. And as you suggested, I think it's just a pure, money grab from the Trump organization's perspective.
In that case, Lee, as we said, cryptocurrencies in general have risen since the election in November. Is there a danger of an asset bubble here? And if it bursts, who stands to lose most?
Well, and anytime you have an asset bubble that bursts, the people who lose the most are the people who got in, right before it bursts, right? And the people who tend to get in, at that last second, at that last minute, tend to be the least sophisticated, the least informed, and the least able financially to absorb these losses. So that is something that really does concern me, because a lot of folks remain skeptical of cryptocurrency. I think if you talk to the average person about it, the first thing that's going to come to mind is Sam Bankman-Fried and FTX. But as you well know, Donald Trump is, wildly popular with half the country. And so when he launches his own cryptocurrency, I think there is a fear that people who, otherwise wouldn't invest in this asset say, hey, if President Trump is doing it, there must be something legit. Let me get in too. So from my standpoint, I think we are kind of in a frothy market. The crypto market has cycled before. There's been multiple boom and bust cycles. That dynamic is not going to change, and I think we could look at sort of this moment with the Trump coin as kind of representing the peak of that bubble. But I could be wrong, and there could be more room to run. And obviously, President Trump is going to try to push for legislation that will help the industry, and maybe that will push prices up further. But this is an asset class that doesn't have, any fundamentals. There's no cash flow. There's no revenue. So it trades entirely on sentiment. And as we've seen in the past, sentiment is fickle. Right now it's positive, but it could change in a heartbeat.
Lee, it's been good to talk to you on Counting the Cost. Thanks for being with us.
Thanks for having me.
And that's our show for this week. If you'd like to comment on anything that you've seen, I'm at @afinnegan on X. Please try to remember to use the hashtag AJCTC. You could also drop us a line. Countingthecost@aljazeera.net is our email address. There's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, and entire editions for you to catch up on. But that's it for this edition of Counting the Cost. I'm Adrian Finnegan from the team here in Doha. Thanks for being with us. The news on Al Jazeera is next.